So go to business past paper, May 2020, paper 1. Tax was set up in the wealthy area of Chipre, England in 2008 by Oli Turner, who had a passion for and enjoyed drumming. Oli invested all his savings into the drumming school. He saw the potential of being located away from other drumming schools. That's location, anyway. Oli promotes his business by writing columns in local papers, performing at local musical festivals, and by words of mouth recommendation. He has invested heavily in computer technology to allow students to produce the music that they enjoy playing. What is music?
Songs.
Music is the act of producing an organized sound. The act of producing an organized sound. That is music. Oli finds it difficult to maintain a good work-life balance. Oli currently works 60 hours a week in a business that does not have reliable profits. Which one of the following could a sole trader pay on its profit? Before we go into that, who is a sole trader?
When one person does business by himself.
Yeah,
It's a small business.
No, it's not just small. It's a business owned and controlled by one individual. That's why I call it a sole trader. Hello, I told you when I'm talking, you don't write.
I'm starting with soul trading.
Okay, but I'm still going to write it anyway. So a sole trader is an individual who set up his own business. The business is owned and controlled by him or her. That makes him or her a sole trader. So we're going to write that first. Sole trader. Business owned and controlled by an individual. That's a sole trader. Now the question, going back to the question, said which one of the following could a sole trader pay on its profit? What is profit? Profit is the return on investment, which is our total revenue minus the total cost. Or yes, that's our profit. So return on investment is a profit. For a sole trader will pay not a sales tax. A sales tax is on consumption. So that's like withholding tax. It's not paid by a sole trader. Income tax is what a sole trader will pay because a sole trader pays the same tax as individuals. I said that when we went to the class of sole trader. They pay income tax, the same tax as individual pays. Corporation tax is taxes on profit for limited companies. Then indirect tax are withholding tax, like taxes on consumption. So it's on consumption. So this is tax on for corporation that's
Mister, can you explain what they mean?
income tax.
No, sales tax, income tax.
Sales tax is tax on your sales. That is,
okay.
yeah, it's more like an indirect tax too. Withholding tax, value added tax. These are taxes. So the only tax here that is paid by a sole trader is income tax. So a sole trader will pay an income tax. Corporation tax is for companies. That's limited companies and public limited companies.
Indirect tax is only for consumption.
Yeah, taxes on consumption. Taxes on consumption. Taxes on consumption. You can write please. Taxes on consumption. Is it clear please? Alright.
Taxes
On consumption. That's income tax. Indirect tax are taxes on consumption. This is on income. This is paid by business, a sole trader or individuals. Individuals. Is it clear?
Yes.
Hello? Hello? While you write it, please pause it. So for LTD, it means private limited companies, and this is a public limited company, public limited companies. I think that's clear, right?
Yes.
So move on to the next one. It said, which one of the following is a variable cost? It said, which one of the following is a variable cost? When we talk about variable cost, we're talking about cost that changes as the level of output changes. Costs that change as the level of output changes. Examples of variable costs are cost on the raw materials, wages, they are variable costs. For wages, it's based on how much more you work, maybe how much more you work or how much quantity you produce. And for raw materials, the more raw materials you buy, the more amount of money you pay on them. So these are cost or these are variable costs. Do you understand variable cost here? These costs, they change as whatever we produce changes. And for fixed costs, we call them fixed costs because these costs are constant, irrespective of our output. Clear?
Yes.
So now we go back to the question. So which one is always a variable cost? Insurance is fixed. It's a fixed cost. Because you pay it once and for the whole year. It's fixed. Rent is fixed.
So, if insurance, if you pay about the hour,
No, you can't pay per hour. Insurance, you are insuring something. So it's fixed.
and rent, you can pay by the.
No, rent is monthly. You use the house or you don't use the house, you pay.
So what you put when you go by day?
When it comes to day by day, those are we call them revenue expenditure. Things you spend daily. That's not about cost. They are expenditures. But here we're talking about cost. So insurance is a amount of you are insuring. You put in the risk that might occur to your assets to the shoulder of an insurance company. So as soon as I buy my car, I insure the car. It's going to be through a year, so it's fixed. I use the car, I don't use the car, I still pay the insurance. Do you get it?
Yeah.
And for rent, as soon as I pay my rent, irrespective of I staying there or not staying there, it's fixed. I have to pay it monthly. You get it?
Yes.
Salaries, it's fixed too. Then packaging is variable cost. Why is packaging a variable cost? The bigger your package, the more you pay. The lesser the package, the less you pay. Is it clear?
Yes.
So here it is D. And variable costs, these are costs. This is a cost. This is a cost. That changes as the level of output, as the level of output changes. Is it clear, please?
Yes.
So Roman figure 2 is done. Go to 3. No, Roman figure 3, yeah. Sorry. Oh. I can't say. Don't you know what?
Mister, you can just.
Yeah, sure. Yeah, so which one is following is the method of primary market research. When we talk about market research, we have market research is about finding out, gathering data about the needs, the wants of customers. So we can do this either through the field or through the desk. We call it a field research because it involves you finding out, getting the information firsthand. So that's what primary research is about. A research that the data you gathered yourself, it's a primary research. But when it comes to using information of those in the past, it is a secondary data. That's the difference between primary and secondary. Either ways, you're seeking out information, you gather data. That is what primary research is about. But how do you gather the research? How do you put this information together? That talks about if it is primary or secondary.
What's the difference between
The difference between primary and secondary is that for primary, you carry out that research. It is first hand. But for secondary, it means you're using the information of a researcher.
the difference?
For secondary research, this research occurs because you're using information of someone in the past.
Oh.
It is not your research. If it's your research, it is primary. But in as much as you're using someone's research or someone's information, it is secondary. That's why we call secondary research desk research. The information is there for us to see. But for primary, it's in the field. You are there gathering this information. I think it's clear. Is it clear, please? So that's about. So for primary market research, it means a first-hand research. We are out there. You are out there. I'm out there to gather information about customers, about products, about our competitors. So here, newspaper articles. Newspaper articles is in desk research because it's already written. Yes or no?
Yes.
Are you guys with me or not? Newspaper articles, they are written by someone. So we are just using the information. It is not primary. It is not our own research. So it's secondary of desk research. Government statistics, these are information in government data. They are secondary.